Hey guys, welcome back to the channel. Now, if you've been at a job long enough to take advantage of an employer's 401k plan, then congratulations on participating in what some argue is the most powerful long-term investment in existence. When the time comes to change jobs and you don't have more than, say, just a few $1,000s in that 401k, the question for many is, what are you supposed to do? And according to a recent report done by the Wall Street Journal, as many as 45% of younger and lower income earners are going to decide to cash out of their employee-sponsored retirement accounts out of sheer convenience. And new action on behalf of the Labor Department is actually going to change how these accounts are treated as workers move from one job to the next. And in this video, what I want to do is analyze these upcoming changes. What do they mean for your financial well-being if you're one of these folks? So make sure you stick around. So it's really no big secret that investing into your 401k through your company's plan, that can be considered a seriously smart move that will ensure overall financial success in the long run. But as difficult and time consuming as it may be for 401k rollover transactions, many job changers actually opt to take their retirement savings early. It's something I did back in my late teens at a retail management position that I held. Just had a few $1,000s in that account, chose to take it as opposed to rolling it over. I used the cash for discretionary items. I mean, people will use that stuff for everything from car repairs to making other investments, but tax penalties on that, I mean, it's just terrible for the earner. But the implications are really even greater, I think, than people realize on the US economy as a whole. And this is why the Labor Department is choosing to take action on this. You see, tax-deferred retirement savings are a huge chunk of what makes up the US economy and what makes it healthy. 401ks in particular are used on a macro scale, and they're used to fortify our country's financial position on the global stage. And when money leaks out of the system due to premature withdrawals, both the worker and the economy as a whole end up suffering. So what are these new actions that the Labor Department is taking? Well, for starters, they're going to be given the green light to administer automatic retirement fund transfers with less than a $5,000 balance in them. And this is being done through what's known as Retirement Clearinghouse. And I'm going to include a link to their website below because I'm not going to talk in great deal about Retirement Clearinghouse today, and I would love for you to be able to learn more about them and really discover more about this process. So check out that link. And what this is essentially going to mean is that instead of having to go through this extensive process of retirement rollovers, the transaction is going to be done automatically unless the employee chooses to opt out of the service. For retirement account balances that are above $5,000, the transfer can still be executed, but the employee's permission will be required instead. So when you add it all up, retirement fund leakage that stems from logistical headaches of job changes, it really does account for a lot of the money that's being missed in the grand scheme of things, the money that's being leaked out. So how much money is this? Well, potentially, arguably, it's billions of dollars when it comes to what could be staying in the retirement system, but ends up being lost. So one of the benefits that could come with this new development is the reduction of duplicative fees or fees that are levied against both sides of the 401k rollover. And instead of paying multiple fees, the earner is actually going to pay just a one-time fee of $59 to take care of absolutely everything. Now, for account balances that are less than $590 specifically, the fee is just 10%. Okay, so if the account balance ends up being just $50 or less, then the transaction is actually completely free. Okay, so anything above $590, there's gonna be a $59 fee. Anything at $590 and below will be 10%, and anything below $50 is going to be free of charge. Now, up to this point, current laws have actually allowed for employers to send post-employment checks to employees that have saved up to $1,000 in their retirement accounts for accounts containing $1,000 to $5,000. Now, the employer must either keep the funds in the established plan, or they're going to need to work with the employee to initiate the rollover to a qualified plan that's sponsored by their new employer. And neither of these options are really ideal because both of them are going to carry fees or taxes that in a perfect world would really stay in those funds. So a retirement nest egg can continue to grow over time, of course. But just to be clear, what Retirement Clearinghouse is going to be doing in processing these new micro rollovers, if you want to call them that, is acting as a fiduciary. And basically, that's an entity that holds a legal or an ethical relationship of trust with one or more parties. And fiduciaries are really important in the execution of a lot of different complicated transactions. I mean, everything from home buying to brokering international assets can involve fiduciaries. fiduciaries. In my opinion, this is really great news, because if Retirement Clearinghouse is going to be able to genuinely help workers keep more of their hard-earned money, the money they're squirreling away for those later years in life, then this is surely going to be a case of the rising tide lifting all ships. For those with or without 401k accounts, be sure to check out some of our videos on alternative retirement options. We've done a number of them. I'm going to include a variety of links in the description below on those as well. You'd be surprised how many options there really are out there, and how some can be a tremendous fit for the right person and situation. And there are many arguments against these traditional retirement accounts that I think are worth consideration. My question to you is, what do you think about all of this? Are you somebody that's actually rated a smaller retirement account in the past like I did, because it was just simply easier maybe than having to deal with the rollover process? I know for sure that that did play some role in my decision back in my late teens. I just simply didn't want to deal with trying to figure out what a rollover even looked like for me. So, and I had even gone into self-employment at that point. My question is, would you have done things differently if those funds ended up running through a company like Retirement Clearinghouse instead? If that was available to you at the time, if there were fiduciaries to help you between your two retirement plans, would you have done anything differently? So go ahead and comment below, guys. I'm very curious to hear your experiences. Don't forget to like this video too. It tells us that these are videos you want us to continue to make. Do you want us to continue to bring you the breaking news and share with you the different changes inside the monetary system, inside the banking system, inside your cash flow circumstances? Guys, we're going to continue to bring you the best content related to going as fast and as far as possible while being as safe about it as possible when it comes to your finances. Until we see you on the next video, make it an amazing day today and take care.